Welcome everyone. Week 2, Wednesday. Week 2 being ideas for income. And today we're looking at real estate with Nick Montgomery from Schroders. And Nick and I were just talking earlier, and we agreed that if you could send back in time a couple of years what interest rates were today, and asked half a dozen property managers what they thought their share prices would be, they'd all agree they would be lower. It's really no surprise. Real estate is a classic interest rate sensitive asset class, and it's been a tough time for any interest rate sensitive asset class in the last year, through no fault of their own, really. But as we come into this new phase of investing, Nick and his team find themselves in a position where they have a weighted average interest cost of 2.8% with a maturity of 11 years, which puts them right at the top or the bottom, depending on how you look at it, of competitive debt in listed REITs. They have a covered dividend, and the portfolio is in pretty good shape. And so there's a really good basis for Nick and team to continue to deliver on their core objective, which is sustainable income growth through investing in UK real estate. And I'll hand over to Nick in a moment just to say that Nick's going to present for about 30 minutes. During that time, please do drop any questions into the Q&A box. I'll go through those, and then in about half an hour's time I'll reappear, and Nick and I will go through some of your questions. And with that, Nick, I'll hand over to you.
Fantastic. Thank you very much, Alan. And really great to have an opportunity to present to you all. And thank you for choosing me over our Chancellor. I think he's standing up as we speak. As per the introduction, my name is Nick Montgomery. So I look after the UK real estate business at Schroders. I'm also a fund manager for Schroder Real Estate Investment Trust. We've got a big real estate team at Schroders, access to great research. And we apply both that top-down research, but also the boots that we have on the ground across our specialist asset management teams, actually both in London, but also having recently opened an office in Manchester. We've got fantastic access to our assets, stakeholders, tenants across the whole country. So what is SRE? Well, the words there, diversification and higher income, tell you what you need to know. And the great thing about real estate is we can show you lots of pictures and avoid having to say too much. But the images here actually represent about 60% of the portfolio by value, and give you an indication of the types of assets that we own, and also the strategy, what's sitting behind it. So we own a really good quality portfolio, direct assets across the UK, which we think are well positioned to capitalize on the structural trends, which, alongside, as Alan has said, particularly recently, extremely high inflation, obviously the response in terms of interest rates, that clearly has had an impact on performance. But actually, going forward, we think it's those long-term structural trends that are going to have the bigger impact in terms of demand for real estate. And those are obviously big trends like demographics, social change. Clearly, the office market is adjusting to the pandemic and what occupiers want from their office space, and then obviously technology, everything from demand for online goods, the impact that has on warehousing, all the way through to new technologies like AI, clusters of businesses who are developing high value technology. And we may hear something today in the budget about the government's productivity strategy focusing on those areas. And the last really significant structural trend, of course, is sustainability, with the real estate sector being the biggest emitter of carbon, 40% of global emissions. And so we are right in the centre of that whole discussion around how we decarbonise our portfolio. So in terms of where we are invested, before I go into the detail, moving from left to right, the images you can see there are two of our biggest industrial assets. We've tended to focus very much on multi-let industrial estates, which make it the majority of our industrial exposure, rather than buying big boxes, if you like. That's largely because, firstly, we see obviously continued growth in online, but also in urbanisation. So owning big multi-let industrial estates on the edge of growing centres like Leeds, like Milton Keynes, actually benefits a whole range of occupiers. And so by owning granular multi-let industrial estates, you benefit from that demand, but actually also because you're in densely populated urban areas, you create the potential for long-term alternative uses. And I've got some examples of that. The office sector, as I touched on in the introduction, clearly is arguably the most difficult sector to price at the moment because of the dynamics around the pandemic, and also the obsolescence risk that's accelerated as a result of particularly ESG requirements. And indeed, the MEES regulations, which govern energy efficiency of buildings, as of April, mean that below a certain EPC rating, space can't be let without carrying out improvements. So it's a clear and present issue. Having said that, we think adaptable buildings, particularly those buildings that can be made to be more energy efficient in knowledge-based economies, absolutely have a place in a diversified portfolio. And we own in locations like Bloomsbury, just north of Tottenham Court Road, which is benefiting hugely from technology and actually, interestingly, life science demand. Equally, we own in stronger regional cities like Manchester, like Edinburgh, like Leeds, where you've got a whole diverse range of whether it's professional services through to technology. And in the case of Manchester, obviously a demand that came off the back of the BBC locating up there, almost 10 years ago. Finally, retail. We don't own any shopping centres. Our retail exposure is concentrated in two key areas. Fashion retail parks, I should say, that don't include any fashion, that were very pandemic resilient. In fact, the image you can see on the top right-hand corner there, we did a deal during the pandemic to let space to both Lidl and Home Bargains, two fantastic sort of discount or mid-market retailers. The other part of the retail market, which is holding it very well, is convenience. So that sort of more expensive basket shop, quite often anchored by small supermarkets in those densely populated urban areas, like the one that you can see just there. Now, having shown you some nice pictures, I'll just give you some stats. The portfolio we own is valued every quarter. Our year end is March, and so we've just announced our unaudited numbers as at 31st December. Obviously, we're going into our year end valuation in March, and just moving from left to right. So our NAV today is just over 300 million, or 62 pence per share. As Alan has said, we've clearly seen a very significant correction in the UK market. I'll come on to the drivers behind that in a moment. We have performed well relative to our peers, and on a longer term basis, we continue to perform well in terms of net asset value total returns. But clearly, we have experienced that correction, albeit performing better than our peers. We manage our assets very aggressively in the way that we actively manage planning consents, refurbishments, leasing activity, but we manage our balance sheet conservatively. So our net loan to value at the moment is just about 35%. And as Alan has said, we have the lowest cost, longest duration debt in the peer group. And I've got some stats on that in a moment. Property performance has been very strong over all time periods. So this is comparing the portfolio of our underlying assets compared with what we call the MSCI. So this is FTSE's real estate's FTSE equivalents, where all of the institutional owners of commercial real estate contribute their data, and that spits out an index. And you can see there over calendar 2022 a negative return. So not the right symbol on the front there, but minus 2.9 compared with the benchmark of -9. And our long-term performance, you can see over 3 years, just over 5%, plays the benchmark at 1.5%. So very good outperformance for the reasons I mentioned: good stock selection, good asset management, and having our exposure, we believe, in the right parts of the UK market. Interestingly, and again, I'll come on to income and dividend in a lot more detail shortly, but we have deliberately chosen to have a higher income return through the cycle. Just to illustrate, over the 3 years, our income return to rents paid was about 6.3%, which compared to the benchmark at 4.2%. Amongst that MSCI peer group of 160 funds, that positioned us second, so the second highest level of income across that entire peer group. And that's just illustrated in a little bit more detail in the middle column there around income focus. And again, some of those stats I'll come back to. Clearly, the company is here first and foremost for income. That's why I own it. That's why most of our shareholders own it. And ultimately, and particularly at the moment, where we are experiencing higher rates of inflation, passing that on to our tenants, deriving higher income growth from asset management, has allowed us to steadily increase the dividend. So over the most recent quarter, we increased our dividend by 2%. We are the only company in our peer group where we are now paying a dividend that's above the pre-pandemic level. And we are hopeful that if we can continue delivering on that asset management strategy, we will deliver that further sustainable growth, and we hope a continued progressive dividend policy. ESG I've touched on. It's a huge issue for the real estate industry. It isn't about knocking down all the brown buildings and building new green ones. In many respects, that's the worst thing you could do. It's about decarbonising the environment in a sensible way that has regard to the issue of embodied carbon. So a lot of our focus within the portfolio is on refurbishments, delivering improvements to buildings without necessarily knocking them down for the reasons I've mentioned. Strategically, I think you will see us apply an even greater focus on sustainability. There is now real empirical data that tells us that tenants are prepared to pay a green premium in their rents, and that investors increasingly want to own more green buildings. And so our focus and our strategy and that the activity of our asset management teams increasingly is going to be driven by both operational excellence in terms of the service we're giving our tenants, but also how we can develop a strategy that delivers those ESG improvements. Now, why do we think S3 is interesting today? We've got a diversified portfolio, and we've moved from a period of time where a lot of demand was for specialist strategies, in particular beds, sheds, and meds, as one analyst put it. But actually, we're moving into a part of the cycle where there will be less polarization of returns, and therefore owning a good quality, diversified, high-yielding portfolio, we think actually is very attractive. Particularly when, and these numbers are slightly out of date now because things are moving so quickly, but actually the dividend yield in response to the recent share price movement actually is now 7.5%. And as we note here, that's fully covered there by recurring earnings. Very strong balance sheet. The share price discount today to net asset value, that's a December net asset value, is just under 30%. And as I note there, that thematic focus on sustainability. Now, this slide has a lot of information on here, but I'll draw out three really important points. So what we're doing here is comparing our metrics to the companies that are viewed as being in our recognized peer group. And these are principally the externally managed investment companies or REITs. And we're trying to contrast how we compare with those peers and why we think it's favorable. So the top line shows the dividend yield, and obviously I've said that 7.1%, you can see there above the orange box at us, is now 7.5%, but you can see, broadly speaking, the peer group has moved up in terms of yield. So we have the second highest level of dividend yield in the peer group, but really importantly, you can see there within the bar 105% covered based on our most recent unaudited NAV. In comparison, the only company that does have a higher dividend yield than us, which is an AEW managed strategy, the yield there is about 8.5 today, but that dividend is only about 2/3 covered by recurring earnings. The discount to NAV I've mentioned, so you can see there we're sort of in the middle of the pack, about 29%. And then finally, and we've touched on this, and I think this is a really key differentiator, given the economic backdrop and the rising interest rate environment. We have the lowest cost there for 2.8% blended, longest duration debt across the entire peer group. And that really gives us a bedrock, if you like, against which we can implement a strategy and hopefully deliver continued growth. This just draws out the dividend point in a little bit more detail. This is showing the quarterly dividends that we've paid over the last few years. We're obviously illustrating the dividend immediately prior to the pandemic, the impact of the pandemic in Q2 20, but then you can see post the pandemic, we have steadily, in a very disciplined way, when we feel it's sustainable, continued to increase the level of dividend to where you can see today at 0.819 pence per quarter. So that obviously gives you the annualized dividend that results in a share price yield of 7.5%. Now, some shareholders are less interested in this, but this is showing the performance of our underlying assets. So not NAV level, not share price level, but looking at the underlying assets compared to our MSCI peer group. And I'll draw your focus firstly to the bottom right-hand corner. And this is showing the relative outperformance of our portfolio compared to that very large peer group comprising all of our institutional peers. And you can see over all time periods now, going back to IPO, we've delivered consistent outperformance at underlying portfolio level. In terms of how we've done it, there are a couple of key themes. The big one is all about income. So if I just direct you to the top left-hand corner where you can see the bars there, you can see, although obviously we did experience a capital value decline I mentioned earlier on, a significant part of our return is coming from income, and that's been consistent throughout the cycle. Now, moving to the market, I guess just in headlines, I think what the chart on the right shows you is that from middle of June 2022, average UK real estate values have fallen by about 20%. And again, just to put that in context, the rate of capital value declines is twice as fast as that which we saw post Lehman during the GFC. So the speed of the response in the market has really been unprecedented, an overused word, but it genuinely has been. I think the key point to note is that so far that's been almost entirely driven by inflation, rising interest rates, and the impact that has on the risk-free rate. And I'll show you a little bit more detail on that in a moment. But in contrast with the GFC, where ultimately the peak to trough decline between 2007 and 2009 was over 40%, actually we think the speed of a correction, the underlying health of the market, for different reasons I'll come on to, means that we think whilst we will see perhaps another 5% capital value decline on average, we think the UK real estate market is poised for a recovery. And that's partly because, as you'll see on the left-hand side, the income yield from the sector are almost 5.3%. So the red line you can see there that moves from about 4.3 to 5.3%, is an attractive level by historical standards. And also, very positively, again, in contrast with the period around the GFC, where there was a higher increase in tenant insolvencies, the actual rental income side, and in fact, the rental growth at the moment in the market is positive. So what we're experiencing at the moment is all about that risk-free rate moving. I'll draw a few more points on that as we come to the next slide. So I guess just starting on the right-hand side, this is a key point here. So what you can see there in the bars is the yield gap. And that, when we say the yield gap, that's a difference between the average rental yield for commercial real estate, which is a green line, and the blue line, which is the 10-year bond yield. Now, the 10-year bond yield today is probably just about 3.5%. The average yield on real estate is about 5.2%. So we've got a gap there about 1.7%. Long run, that gap is about 2%. So we're moving back towards basically being in line with long-term trends. And so I think, as I say, there is the scope to see a further 5% decline in average capital values, but we think we're moving towards a period of time where the sector is actually looking pretty fair priced. Now, there is, of course, a risk. On the left-hand side, you can see the cost of debt has increased. So real estate lenders and borrowers typically hedge their debt for 5 years. And if you're looking to hedge your debt for 5 years today, the average hedge cost might be about 4%. Add your margin on top, you're at about 5.5%. And so, that means at today's prices, debt isn't accretive. But actually, there is not a huge amount of debt in the market. Again, in contrast with the period immediately running up to the GFC, the debt in the system, the levels of loan to value that banks were lending at is completely different. So although we do expect to see some borrowers, owners of real estate, have to refinance at higher rates, that could lead to some selling. And that's why, as I say, there is still that note of caution about market prices. The market is not as exposed as it was during the GFC, which is why we don't think what we're experiencing at the moment is going to be anywhere close to the correction that we saw then. And this just, I guess, outlines where we see the outlook. So from today, we believe that the average real estate portfolio might deliver a return of about 6%, taking a sort of a 5 to 7 year view. And on the chart on the right-hand side, you can see we're showing the decline in values up till 2022. And then you can see the outlook. And actually, despite the fact that the industrial sector actually has seen the most significant value declines over the course of the last 6 months, actually the structural tailwinds that we still see in that sector means that we do see a recovery in the industrial sector, and we think we're well positioned for that. I guess the last point I'd note, which is interesting, is obviously, the last 5 or 6 years, really, the UK has seen less inward investment into real estate than we did in the previous 10 years or so. That's partly because of Brexit-related uncertainty, clearly the pandemic, but also concerns about political risk and obviously currency volatility. A lot of that risk, we think, has reduced. We do have more political stability. Sterling has stabilized. And probably most importantly, because the UK real estate market is very transparent from a valuation perspective, international investors can see that we've experienced a correction ahead of other markets. So what we're showing here, the red line is showing the numbers you've already seen, which shows that 20% average value decline from peak. Compare that to the continental European real estate markets, that correction has really not come through at all yet. Now, we're expecting it to come to an extent, but I think it's partly because investors are seeing that we've had the correction in the UK. We are beginning to see more demand. In fact, a recent investor intention survey, the UK was the second most popular market globally amongst Asian, Middle Eastern and US investors, and we are beginning to see that come through the transaction market. Now, in terms of our strategy, I'm not going to spend too long on this because I've touched on some of the key themes already, but we have a diversified portfolio, but one that is allocated to the high growth parts of the market. And at Schroders, as I say, both in London and Manchester, we have the specialist expertise on the ground who can deliver the strategies in-house. We do have a real focus on this concept of operational excellence. Tenants increasingly are demanding higher service levels. They want more data, partly in order that they can satisfy their own ESG objectives. We have a disciplined approach to new investment. We are, we're always, to a certain extent, looking at where we can buy and sell. At the moment, our focus is very much on investing within our portfolio, where we think, at least at the moment, we're going to generate higher returns. Balance sheet I've touched on, and ESG leadership I'll come to in a little moment. So where are we allocated? So this is a breakdown of our portfolio based on the information as at December. And I'm not going to go through all of these numbers, but we have highlighted those that are most relevant. So first point to note is we're very diversified and we have a granular rental income stream. So 41 assets as at December with over 300 tenants. So that gives us a fantastic granularity, reduces the risk of any one single tenant. Our income profile is much higher than the benchmark. So you can see there the net initial yield, which is essentially taking your today's rental income as a percentage of your portfolio value. 5.8% compared to the benchmark of 4.7. The reversionary yield, which is the same calculation but takes the valuer's view of today's rental value, so what would the portfolio let at, were it all vacant today, as a percentage of the value. Again, you can see there almost 200 basis points premium over the benchmark. In terms of where we're allocated, well, we think we've got the right tilts. So the dotted blue lines you can see there, we're fairly significantly overweight the rest of the UK industrial market, but that's very much the multi-let industrial estates, which I'll come on to in a moment, and also what we describe as value retail warehousing. So, food-driven, mid-market retail-driven, convenience retail warehousing and other convenience retail assets. To provide a bit more colour on it, again, increasingly, we've got engagement with shareholders who are wanting to get more into the bonnet of a company and understand the assets that we own. So we're being very transparent in the terms of information that we provide. So you can see on the left-hand side here, these are our 15 largest assets that represent almost 80% of the underlying portfolio. And if you look down the list, recognised towns and cities across the UK, again, with that emphasis very much on multi-let industrial estates, offices in winning cities, and actually in some cases, offices where we have universities as tenants, which again goes to that point about knowledge-based economies. Our industrial portfolio, so we've included this because clearly there has been a lot of discussion about the outlook for the industrial sector. As I mentioned earlier, the average UK asset has fallen about 20%. The industrial sector actually on average has fallen about 28%. So it's important, we think, that shareholders get a proper sense of the types of assets that we own. Again, transparently, this is the vast majority of our industrial portfolio exposure. You can see on the right-hand side in those images, Milton Keynes, Leeds, Manchester, really good locations. and critically locations where there is an undersupply of new warehouse developments. If you look at the income profile, you can see here our average initial yield on the industrial assets we own are about 4.9%. That's above the average for all industrial. Probably a more interesting metric, if you move up the slide slightly, is the average value per square foot. So our industrial assets are valued at an average rate of about £88 a foot. We know from developments we're doing at the moment that to develop new industrial costs about £105 a foot. So our assets, and this is just the bricks and mortar or the crinkly tin, is valued at below replacement cost before you allow for the value of the underlying land. So that's why we focused on the multi-let estates rather than focusing on the, if you like, the big box logistics units, where there's an awful lot more value attached to the tenant credit, and where you have less opportunity to actually add value directly as an active manager. Now, I've talked about tenant covenant strength. Again, I'm not going to go through all the information here, but we've given you our top 15 tenants that represent about a third of the portfolio by rental income. Again, just to put it in context, I mentioned earlier 300 tenants in total. So you can see how the tail of 285 tenants makes up the balance of around 2/3 of the income. And that's fantastic granularity. That means that we, as I say, we don't have significant tenant credit risk. Looking down the list of tenants, the University of Law, our biggest tenant, just over 7%. They're one of the biggest providers of legal training in the UK, based out of the university we own down across into the West End in Bloomsbury. Siemens, Buxton University are another university tenant who actually specialise in nursing, so they're seeing huge demand at the moment. And the rest of the names there that you'll probably find in many cases are familiar. Void analysis, again, we're very transparent about void. Our void at 8.6% is, broadly speaking, in the middle of our long-term 10-year range of 5 to 13%. And again, we're setting out here how much of that void space is under refurbishment, and obviously therefore where we're more confident about the letting prospects, and how much also is under offer. And again, if you start to follow us, you'll see we provide regular updates to shareholders, giving updates on that activity. Now, a few more minutes left, but just in terms of key asset management initiatives, again, what we're trying to do is give shareholders visibility of where the valuation and where the additional income is going to come from. So we're setting out here 4 of our key asset management projects where we're either on site or where we've got proposals which we think could add significant value. Moving from left to right, we're developing some new warehouse units on a small site that we own on the edge of our industrial estate in Milton Keynes, where we think will deliver a very attractive return on capital of about 7% versus buying that standing in the market at around 5%. The most significant activity we have on at the moment is our industrial estate in Stanley Green in Cheadle, South Manchester, where we're close to completing an operational net zero warehouse scheme that has the potential to deliver about 1.3 million of additional rent, all of which would go straight to the net income line and support further dividends. We're developing a couple of Starbucks units on our retail parks where we're delivering a very attractive return on cost, and again, getting long leases to a strong tenant with inflation-linked reviews. And finally, at Chippenham, which is a big multi-let estate we own just off the M4, we're in discussions with a major tenant there to look at the possibility of building them a new facility, which again will be on the basis of a long lease, potentially with some inflation protection. So I guess the key point here is by virtue of owning a large, diversified, active managed portfolio, there are always situations like this where we can add value through the market cycle. Debt I've touched on. Again, given time, I won't spend too much time on this, but you can see there we've got 2 tranches of debt. We've got a long-term loan with Canada Life. You can see at the bottom there, 129 million, average cost of 2.5% with a fixed maturity of 13 years and a flexible revolving credit facility that we use to supplement that. Sustainability, we've touched on. Again, I'm not going to spend too long on this. There may be some questions about sustainability, but the company, alongside Schroders as manager during the most recent financial year, made our own net zero carbon pathway commitment. And there's a huge amount of work going on across our whole portfolio, mapping the net zero carbon strategy at asset level to ensure that we are able to achieve those longer term net zero objectives. And finally, I won't spend too long on it. I guess what we're just trying to draw out here really are the key points. I hope they've come across. I think the key points to note are we have a very good quality portfolio. I think today shareholders will benefit from being more diversified, whereas obviously over the last few years, beds, sheds, meds strategies have delivered higher growth, but that has changed. And I guess most importantly, that all we have a very attractive dividend yield of about 7.5%, reflecting a discount of about 30%. And as you've heard, we're fully covered on the dividend, and there's the activity across the portfolio that we hope will allow us to deliver a progressive dividend policy over time. So I have used my allotted time, Alan, but very happily go to questions.
We've got you well trained there. 30 minutes exactly. Brilliant. So thanks, Nick. That was really interesting. And I don't suppose it will be a surprise to you, and it wasn't a surprise to me to see the working from home initials appear in the queues box a
Yeah,
couple of times, and I suppose that, that wrapping a few questions up together. I mean, obviously, that's a specific reference to offices,
yeah,
and what is the, what's the impact, what's the ongoing impact, and what's the evolution of the office space, and I suppose, there's a kind of wider issue as well, isn't there, that post-pandemic there's still
yeah,
supply chain issues and cost of living, and what does that mean for warehouses and legit, the areas that were incredibly popular in the pandemic. Does that tail off? There's quite a few questions in there, but it's
yeah,
really a kind of post-pandemic. What's the scene for offices and warehouses?
yeah. So look, it's a great question. I think if we start with the office sector, um, it is. Firstly, I'd say we are seeing across our estate a steady increase in people returning to the office. First of all, um, I think that's a trend that is more obvious in the bigger towns and cities where they are more focused on the, if you like, knowledge-based front office. Um, what we don't own, I'm pleased to say, and this has been a deliberate strategy, is sort of the out of town office market, which is more back office administration, where I think businesses have been more able to move to more of an out, sort of a working from home model only. And I think in some cases we don't see that changing. But as it relates to the more knowledge based economies, there is this war for talents. Our experience here is that in many cases, the younger members of the team were desperately keen to come back. And therefore, the opportunity is to create space that employers see as being a driver of attracting that talent. And so that's the polarization that we're seeing. If I look at our office in Manchester that I showed at the first image there, we've just gone through a phase of putting in a whole load of new bike stores, showers. We've got a yoga studio. We're running well-being events, things that we just wouldn't have done 10 years ago. And it's all about being able to offer that to our tenants as amenities that mean they're more likely to lease our space for longer and they're more likely to pay us a higher rent. And so our focus is on selling those assets in the office sector where we're not able to deliver those improvements essentially. And where we own those assets, that focus on operational excellence, delivering the highest service levels to tenants that will allow us to deliver those higher rents. I think from an asset allocation perspective, we have been very deliberate in buying in locations where there are those drivers of demand. So, for example, the asset in Bloomsbury I mentioned, that is a market that's benefiting hugely from infrastructure improvements, from life size demand. So again, although we're less in control of what happens there because that's a single asset at the moment, we're not in control of it ourselves. We're very confident that taking a longer-term view, that location will continue to improve. Obviously, Crossrail has had a fantastic impact on the office market. And I guess, if you take the city office market as an example, you know, rents are being agreed in the city now at the highest ever levels, but only for the very best buildings that can deliver those enhancements. The grade B market, the poor quality assets, it is very difficult. I guess the last point I note on the office market, which is big picture point, but in most regional markets and indeed in central London, the amount of supply versus equivalent points in previous cycles is nothing like as high. If you go back to the early 90s, the period in the run up to the GFC, there was a significant oversupply of offices, and we just don't have that today. So if you do own a good quality grade B office and you can improve it to be an A- office, then we think actually that is an interesting opportunity, and that's where I'm pleased to say that that's where most of our exposure is today. On the warehouse side, I think so I was very deliberate in explaining that our exposure is restricted to the multi-let market. So if in the last 5 years, if you've been an owner of industrial land anywhere near a motorway, you wouldn't build a multi-let estate. You'd go and find a pre-let from an online retailer, or a physical retailer that's building out their online capabilities. You do a long lease and you'd forward sell it to an institution. What's happened in most, I guess, more recently is we've seen a supply response to that demand, and of course it always lags. So at the point in the cycle where we're seeing less or slightly less demand for logistics, we're starting to see the supply that was committed over the last few years starting to come through. So we are more cautious about the outlook for rents for logistics. We've also just gone through a business rates revaluation, which will see logistics see a fairly significant increase in rates. And obviously, in some cases, those tenants are quite heavy energy users. So although rents remain a relatively small proportion of end users turnover, or of costs, I should say, actually we do think that will lead to slower rental growth for logistics versus multi-let industrial, where really nothing has been built. If you go to the big urban centres, in some cases actually there's been a reduction in supply because it's gone to alternative uses, housing or retail. So for that reason, and also the fact that the multi-let industrial market has a much more diverse occupier base, that's why we've allocated more to that sector, and actually we're pretty bullish about the prospects for continued growth.
That's that sort of squares with our experience of central London offices versus regional as well.
Yeah.
So just trying to wrap a few. There's a few questions that are kind of a macro nature, and so if we think inevitably you're being asked what your outlook for interest rates is, and I guess that's a Schroder's. Schroder's probably has a house view of that, and clearly that's key for real estate
Yeah.
valuations. But also in the sort of bigger picture category, how do valuations have come down, but how do they compare to our closest neighbours in Europe, for example? And then some other questions about things like, what's the kind of correlation or even explicit linkage between inflation and the kinds of leases that you're writing, and
Yeah.
are you seeing any pressure? You mentioned that central London offices are getting some of the highest rents per square foot you've ever seen, but what's the kind of more general picture around the country?
Yeah. Okay. So if I look at what we know as a fact, then in contrast with the significant downward movement in capital values over the second half of 22, so sort of 20% down, 28% down for industrial. Over that same period, the industrial sector actually enjoyed continued rental growth. So that's unusual. It's unusual to have such a significant fall in capital values, but with rents actually going up, albeit at a much slower rate than that which we've been used to. And that's partly a function of the fact that the correction we've seen was clearly accelerated post mini budget, but it was all about that re-rating that all asset classes have seen, which really began the early part of last year. And I think it's also a reflection of the fact that there isn't that oversupply of space in the multi-let market and in most other parts of the market, with the exception of logistics that I've mentioned. So that's the first thing. I guess on the inflation question and the sort of broader macroeconomic point, I think long run, real estate is a reasonably good hedge for inflation, but principally on the income side. So if you take the long run real return for real estate, long run is about 5%, of which about 6% came from income. So that's why we love it as an asset class for income. Over shorter periods, it's far less correlated over really short periods, but long run we know that's the case. We've also seen an increased incidence of rent reviews following more of a continental European model, where they are hardwired to CPI or RPI, obviously with RPI being phased out in 2030, but mostly now CPI. And that's particularly prevalent in alternative sectors where there's less of a market to extract comparable evidence. So you'll see that a lot in hotels, healthcare, for example. And we have a proportion of our portfolio that's linked to that, but you tend not to have that sort of lease structure within multi-let industrials where the leases are shorter, or indeed in parts of the office market. So, I've mentioned tenants like Lidl, Starbucks, some of the fairly significant new leases we're discussing in a moment, where we can manufacture that RPI linked income, we will do. But actually going out and buying it in the market, it can be quite expensive, which for us doesn't really work when we're trying to deliver such a high income return. Having said all that, actually, if you look at the income growth that we've seen from industrial over the course of the last 2 or 3 years, it's been way ahead of inflation for the structural reasons I mentioned, the attractive demand supply characteristics. And the view within Schroders is that although core inflation is stickier than we would like, directionally, clearly, with the impact of the very high energy prices starting to come out of the numbers, we will see CPI trend back down to much lower levels, 2-3% maybe, as we move towards 2025. Now, what that means in terms of interest rates, again, you could argue we're already seeing it in terms of, forward-looking rates have come off quite significantly. Obviously, the 10-year is about 3.5% today. And so I think actually, if that comes to pass, that could be quite a benign outlook for real estate. Because, again, I've illustrated the point. If you look at the premium or the spread between the 10-year gilt rate and where real estate yields are now, we're back pretty much at historical averages. We don't have a significant supply issue coming. Yeah, we don't have a significant pipeline in new development really anywhere other than the point I mentioned about logistics. And although we are obviously expecting to move into a lower growth environment, again, people have their own views. Do I see a deep, prolonged recessionary environment? Probably not. And so I think for those reasons, we think the correction that we've seen in the UK, 20%, possibly going to 25%. And again, going to that last point you mentioned, Alan, about the continental European market, in an environment where the European market is only off 6 to 8%, and the UK looks more investable than it has been probably for the last 5 or 6 years, means that we think actually the prospects for the UK market are actually pretty good.
Yeah. That's right. Europe really hasn't come down as much, has it? So just with one eye on the time, I'm going to
Yeah,
try and wrap a couple of other questions into what I would categorize as opportunities, question mark. So has anything either through a fall in value or because society changes and real estate changes with it, and we saw the last mile logistics was a great, is there anything else that you see on the horizon changing? Is there any exceptional value that you're not currently invested in that you might consider? And I'm just going to link that to somebody's mentioned, for example, childcare is obviously a hot topic, and none of us are watching the budget, so we don't know what the money is. But it's rumored to be a substantial. But could that be an opportunity in Grade A offices? Is one question. And I guess the last question on opportunity is, what about your own shares and share buybacks? So there's quite a lot in that.
yeah,
So we'll have to call it the last question.
Yeah.
We're sneaking about 4
Yeah.
questions in under the wire there, but let's see how far we get.
Yeah. Well, if I think, can people still see the slides? I was going to move to
Yeah, the slides are still up. Yeah.
yeah, great. If I just go to, it's a slightly cop out answer actually. But if you, I mean, if you look at the chart on the right, these are our forecasts looking forward. And I guess the first point to note is you'll notice, and I think this isn't reversion to a mean. I think there's actually substance behind this, that we don't expect to see the same degree of polarization that we have had over the course of the last sort of at least 5 years or so. And so what our forecasts are telling us is, amongst the main parts of the market, and particularly for a strategy like ours that is income focused, owning multi-let industrial estates, investing in them, developing around the edges, improving them, particularly improving their ESG creds, is I think it will be probably the more attractive part of the market going forward. Alongside that, as I mentioned, retail warehousing, value retail warehousing, particularly where they can be part of that multi-channel retail experience where people can click and collect as well as buy in store, if you like. We think is also an attractive part of the market. I think the office sector, there'll be parts of the office sector that we should just absolutely avoid. Value traps, however nice a yield, if they're out of town, if they can't be adapted to today's modern requirements, then your best hope might be farmland. Having said that, I think actually at the moment we are beginning to see some offices in big 6 regional cities at very, very attractive yields. And if you've got the expertise to deliver the asset management strategy, to deliver the ESG improvements, to position them in a way you attract occupational demand, that I think actually is quite interesting, because you can now buy some offices, and I'm not suggesting we're going to do this yet, but literally 10, 11, 12% yields when they would have been 6, 7% yields, even a matter of 2 or 3 years ago. But that's largely about having the asset manager's expertise to execute, which we do. I do think, having said that as well, when we look at our forecast, alternative property sectors, I think, are also really, really interesting. You mentioned nurseries. I think part of the challenge with sectors like nurseries, and it's a bit like doctor's surgeries, is actually it's how you get scale quickly enough, because in isolation they're obviously very small. So I think for us, for those types of this market, we're I think equally likely to be to be looking to put them as part of multi-let building. So for example, we've actually got a creche in our convenience-led scheme up in Leeds. We're looking at it as a possibility of an asset in Manchester. Likewise healthcare. And I think also some of those alternative sectors, and I'm thinking, potentially hotels, parts of the residential market, are most sensitive to inflation. And so actually, if we could buy those sectors at a high enough yield, then I can see how they could complement our long-term strategy. But as I say, the sort of cop-out answer I gave you, which unfortunately is true, is there is no one sector at the moment where, when we're looking at our forecast, we can see anything like the degree of polarization that we have had over the course of the last few years.
Yeah, I guess there may be some polarization in the development end of the market, where there's there's a very different kind of dynamic, and it's not something you really get involved in, is it? But the new newly built is something that it's a different business to Schroder's Real Estate, isn't it? So,
but it is. I mean, look, it is and it is, and I'll just finish off by one of the key value drivers we think for the company, this year will be the Stanley Green trading estate. And again, I didn't spend too long on it, but that's a really good example actually of our strategy in action. We bought an existing multi-let industrial estate. There was a site attached to it, which had consent for about 50,000 feet. We got consent for 80,000 square feet, and we are very close to completing an operational net zero development. So the beauty of a deal like that, which works for S-REIT, is you've got income carrying you through that process. And also you end up owning a stabilized investment at a much higher yield than we would otherwise have done, buying it standing in the market, or if you like, oven ready. So I can see, particularly as our strategy evolves and becomes more focused on delivering ESG enhancements, buying stabilized income assets that have that potential for developments on the side, I think is we will definitely do more of that.
Do you want to, before we wrap up, do you want to just briefly touch on the discount and
Yeah, sorry, I did. Yes, I did forget that. Yeah, I look. If I go up to so I guess what I'd say is we do think the shares represent very. I'm sorry, I'm skipping around here. It's that slide. Represent very good value. And actually, a lot of the steps that we've taken versus peers in terms of continuing to decrease our dividend has meant that our discount scrubs up relatively well against peers. So we have seen that improvement. We have tried to pull as many levers as we can do to address it. So, the refinancing that we did 3 and a bit years ago to lock in that long-term debt. We reduced our fees, for example, to be bang in line with peer groups, so we could pass that saving on to shareholders. We have undertaken some share buybacks. We actually bought about £10 million worth of shares back about 18 months ago. Just at the moment, I don't think buying shares back on their own is going to have any material impact on that discount. And at the moment, having bought back shares and with one eye on our long-term net loan to value targets, our view is that we are on balance better today to allocate that money into the portfolio and the improvements that we're delivering. I guess I'll finish by saying I think part of the issue we have is a lack of differentiation, and amongst our peer group there are a number of companies that at least on the tin appear to be doing something quite similar. We've taken steps, I think, as it relates to debt and dividends to start to differentiate ourselves on financial grounds. But what we are looking to do going forward is, and I've touched on this a couple of times, try to differentiate ourselves by placing more emphasis on that sustainability criteria, not in any way to sacrifice return, just to be clear, because actually we think delivering best-in-class buildings from a sustainability perspective will lead to more sustainable long-term returns. And so I think by positioning in that way, not only will we hopefully deliver better returns, but we will also hopefully stand out a bit from otherwise what is quite a crowded peer group. So that Alan, I'll just finish on that because I do think that's something which hopefully, if you
yeah.
and others follow us, you'll see that strategy evolve over the course of this year and into next.
Yeah, and I think you've elucidated that extremely well today. So I think with that, hopefully I've covered at least a flavour of most of the questions that have come through. Obviously, everyone knows our contact details if they have any other burning issues, which we can perhaps try and help with offline. But I'll thank everyone who's stayed on. I can see there's still quite a number of people still on, not tempted to go and watch the budget. So we really appreciate your attention when there are other things going on. And Nick, we'll see you soon. Thanks so
Pleasure.
much.
Thanks everybody for your time.